Hello and welcome to FAR-5. And guys, I'm sure that day is not too far when you're going to be experts in financial accounting and reporting. And now in this section in FAR-5, I'm not only looking at your GAAP financial accounting and reporting, we'll also talk about taxes that you pay to Uncle Sam on your tax return filed with the IRS, the Internal Revenue Services. Now, if you recall, when I taught you the income statement way back in FAR-1, I said on tide, no C. And the T of tide, that was taxes. And if you remember, I told you these taxes, they could be current or deferred. So we'll talk about current and deferred taxes. First, the current taxes. This is the tax number that you have on your tax return which is filed with the IRS. So this is the number on your tax return which you pay to the tax authority. Now, as you can understand, we're talking about two sets of books. Number one, the GAAP books for your financial accounting and reporting. And number two, your tax books based on which you're going to file your tax returns. And there could be differences between these GAAP books and these tax books. And now we're going to divide those differences into two types. Number one, permanent differences, which are going to permanently remain between these two books. And number two, we'll look at temporary differences, differences which are going to be there now, but they'll reverse over time. So first, let's talk about permanent differences. Let me start with talking about municipal bond interest. So let's say you've invested in municipal bonds or state bonds and you're getting interest from those bonds. Where does that go? That is your non-operating income, your income on your GAAP books. But now the good news. The good news is that that interest is tax exempt on your tax return. So you don't have to pay taxes. So guys, you've earned it on your GAAP books. But I'm telling you, you don't have to pay taxes on that income. It's not a taxable income. Let's say you've paid certain fines or penalties, or you've tried to act too smart and you've paid bribes and kickbacks. Shh. Now, that's an expense on your GAAP books. But the IRS says, no. They are not going to allow you any deductions for those fines, those penalties, those bribes and kickbacks. So it's an expense item out here, but that's not allowed as a deduction here. So you still have to pay taxes on that amount. So that's again a permanent difference between these GAAP books and these tax books. Let me give you a few more examples. Let's say the company has certain life insurance policies on the lives of its officers, its CEO, CFO, its controller, such that if the officer dies, life insurance proceeds come to the company. That means the corporation, the company is the beneficiary, not their families, the corporation. So guys, in that case, when the company is paying out life insurance premiums on those policies, that's an expense on your GAAP books. But the IRS says, you've tried to act too smart. We're not going to allow you this expense. So it's an expense here, not deductible for calculating your income tax. Now later, when the officer dies and the company receives life insurance proceeds, that's income here. But now the IRS says, okay, we didn't allow you deductions when you paid life insurance premiums on the life sources officers. Now that you've gotten life insurance proceeds, we'll not tax you on that. So guys, you're getting it. When you're paying out the life insurance premiums, expense here, not allowed on your tax returns. When you're getting life insurance proceeds after the officer is no more, that's income here, not taxable here. Again, permanent differences. So guys, let's say we start with our book income before tax and try to calculate the taxable income that's going to come here. we'll have to make adjustments for these permanent differences. And I've already given you a few examples. So let's say when we have muni bond interest, that's income here. When we have life insurance proceeds on the death of any officer, that's income here. Now think about it. If I'm moving from GAAP income to my taxable income, I'll have to take these off. So that's included here. Take it off from here, reduce it, and I reach my taxable income. But when we have the fines, the penalties, bribes and kickbacks, when we have the life insurance premiums on the licensed officers, that's an expense here, not deductible for your tax returns. So those we'll have to add them back to get to taxable income. So guys, as you can understand, these permanent differences affect your current taxes on your tax return, but they do not have any tax impact later. Guys, think about it. The IRS, they are not taxing the muni bond interest today. Will they tax it tomorrow? No, they won't. So these are permanent differences which only affect your current taxes, no tax impact later. So let's go to the book, look at these permanent differences, and then we'll come back and I'll talk about temporary differences, differences which reverse over time. And it's these temporary differences that create deferred taxes.
We'll start with looking at deferred taxes from FAR-5, page 2. So it says, in the US, two separate sets of accounts are maintained. The first one, highlight financial statements. Those are governed by FASB, underline GAAP rules. That's all we've been learning in FAR. Now the second set of accounts, highlight income tax returns. And that is governed by the IRC, Internal Revenue Code, or you could say it's the underline IRS tax code. IRS stands for Internal Revenue Services. Now come down towards the bottom of this page where we have an income statement out there. So you have on-tied, no-see. Now the T of on-tied, taxes, that could be income tax expense current or deferred. So highlight income tax expense current and also highlight income tax expense deferred. Now deferred income tax expense, that's right, due to temporary differences. And we'll talk about that in a moment, but for now make a note here. Income tax expense deferred, that's equal deferred tax liability minus deferred tax asset. So the way you calculate the income tax expense deferred is deferred tax liability minus any deferred tax assets. Moving on to page 3, we're talking about permanent differences between the financial books and the tax books. Now this means, right, no tax impact later and no deferred taxes. Now we just saw deferred taxes, that's due to temporary differences, differences which would reverse over time. Permanent differences, they would never reverse. So there's no tax impact later, there's no deferred taxes. These permanent differences, right, affects current taxes only. And also highlight, no deferred taxes need to be recognized as there are no future tax consequences.
Now guys, we've been spending a lot of time together, and before we go on further, I need some feedback from you guys. And my question to all of you sitting here in class is, do you like Miles books? Do you like all these books from Miles? Do you love the cover pages, the colorful books that we have out here? Do you love the big font that I have on these books? Or do you like how spacious my books are? Do you love the content, the systematic content that we have here? Or do you really love the writer of these books? So guys, my question to you once again is, do you like Miles books? Now, I had one of my students who had studied literature and then came up to me to study accounting. And the way he answered this question is, he said, Varun, these books are my dates on Saturday nights. He said, Varun, your voice is music to my ears. And he said, the writings on your books, that's ecstasy to my eyes. He said, the feel of these books bring him warmth, all the joys and pleasures. So guys, your question is, do you like Miles' books? Yes, yes, yes. So all of you here are saying, you like these books, and some of you I can hear are saying that you love them. So guys, that you like these books, you love these books, you got to make sure that you allocate more time to these books. So now that you've told me that you like these books, make sure you spend more time. Make sure these books, these are your dates on Saturday nights. So since you like Miles' books, I'm going to tell you to allocate more time to these books. Okay, so we had a nice feedback session and I've given you a good tip for you to get your CPA exams. And guys, this is also your mnemonic to remember deferred taxes, which are created out of temporary difference between these gap books and these tax books. Now, these are differences, as I told you, they're going to reverse over time. So now you got to remember that it's a deferred tax liability, the L of liability. It's a deferred tax liability if it's more book income today. It's a deferred tax asset if it's more tax income today. So guys, it's funny, it's cheesy, but it's very interesting. So do you like Miles' books? Do you like all these books that I have for you guys? Yes, you do. Allocate more time. It's a deferred tax liability if it's more book income today. It's a deferred tax asset if it's more tax income today. So let me put it here. So it's a deferred tax liability, and we're looking at the L. If it's more book income today. It's a deferred tax asset if it's more tax income today. And I'm saying today because it's going to reverse over time. Guys, we're talking about temporary difference. So deferred tax liability, that goes on to the liability section of your balance sheet. Deferred tax asset, that's an asset on your balance sheet. Now let's look at the journal entries here. So when I'm looking at deferred tax liability, the journal entry here would be creating this liability, DTL would be credit. When I'm creating this deferred tax asset, I would have DTA as the debit. The other side of both these journal entry is going to be your income tax expense. So when I'm creating a deferred tax liability, it's got to be a credit number. Liability, that's credit. So I'll have income tax expense deferred on the debit. When we're creating the deferred tax asset, that's a debit number. So on the other side of the journal entry, the credit on this journal entry is going to be income tax expense deferred. So you're going to have dollars here, you're going to have dollars here and dollars here. So guys, now let's try to look at what's happening with our balance sheet and our income statement. When we have a deferred tax liability, we're going to create a liability here, DTL, and it increases our income tax expense. Expense, that's a debit account. So if it's debited further, it increases. So a deferred tax liability would increase the income tax expense here. So I would say deferred tax liability comes on the balance sheet here, flows in on my income statement, increases the deferred tax expense. Now, when I'm looking at deferred tax asset, that's an asset on my balance sheet. Now, when we create the deferred tax asset, it reduces the income tax expense. Income tax expense, expense debit account. When you credit it, it reduces. So plus DTL for the year minus DTA for the year. So guys, that's how you look at it from an accounting viewpoint. Now, simple way, once again, question, do you love Miles books? You do, allocate more time. It's a deferred tax liability if it's more book income. It's a deferred tax asset if it's more tax income. And I've given you journal entries. So DTL flows into your balance sheet, increases your income tax expense. DTA flows into your balance sheet on the asset side, decreases your income tax expense for the period. Now get the concept right. More book income. Now this means that you have a lot of income on your GAAP books today, but you're not paying taxes on all that income. You sort of hide it. And then you have a temporary difference. But guys, as I told you, this temporary difference, it's going to reverse over time. So later you will have to pay taxes on this income which you haven't paid today. Once again, more book income today. So your income on your GAAP books is more than your tax books. So you're not paying all the taxes on all the income that you've earned. You're hiding some of that income. Later, you will have to pay taxes. You are not paying it now, but later you will have to pay. That's why it's a liability. Now, looking at the next one, more tax income today. So, tax income is more than book income. It means that you haven't earned the money yet. You haven't earned the income yet. But the IRS, Uncle Sam, they want to tax you even before you earn it. So guys, you haven't earned it, but you're paying taxes today. Later, when the difference is reversed or you actually earn that money here, you do not pay any taxes on that. So it's something like you're prepaying your taxes and hence it's a deferred tax asset on your balance sheet. So guys, since the tax amount is included in the current taxes, so the tax amount that you have on your tax return, that's there on your current taxes. So if you have a deferred tax liability such that it's more book income today, you have to pay taxes later, it's a liability, you add the deferred tax liability for the year. You've prepaid some taxes, tax income is more than book income, you've prepaid some taxes, that's not expense now, that's going to be expense when you're going to earn the income. That's a subtract, it's less here. So guys, let me give you a few examples on temporary differences so that you can perfectly understand and appreciate this concept of deferred taxes and understand how it affects your income statement, how it affects your balance sheet. So let's go to the other side of the board and I have a few examples for you where I show you cases where you have more book income today or more tax income today. So let's get started. So getting back to our mnemonics, question is, like Miles books, like these books, allocate more time to these books. So like Miles books, allocate more time to these books. So it's a deferred tax liability if it's more book income today. It's a deferred tax asset if it's more tax income today. So let's look at a few examples for deferred tax liabilities and assets. So what I'm saying is deferred tax liability means more book income today. So you could say book income is greater than tax income. So looking at your books and your tax returns. So to start with an example, let's talk about construction contracts that we learned in FAR-2, and you got to remember this. So in construction contract we had two methods, percentage of completion and completed contract method. Now let us say for your financial books you've used percentage of completion. So on your books you've used percentage of completion, and so we have, let's say, year 1, year 2, year 3. And you completed, let's say, 25% of the contract in year 1. Let's say you did 40% in year 2 and 35% in year 3. Your total gross profit from the contract was, let's say, 100. So 40 plus 25, 65 plus 35 calculates to 100. Now, that was for your books. Now, let's say for your tax returns, for taxes, you used completed contract method. What was your income or your gross profit when you completed 25% of the contract in year 1? No guys, we're going to wait till the contract is completed before we recognize any profits on your tax return now. So nothing in year 1. Year 2, no, 65% done, but we are waiting for the contract to be completed. But in year 3, when the contract is finally completed, then all this 100 profit is going to come into your tax returns. So year 1 is 0, year 2 is 0, but year 1 plus year 2 plus year 3, that is 100. So guys, in year 1, on your books, you're going to have this 25 of income. So more book income. On your tax books, you won't have it. Year 2, you're going to have 40 on your books, nothing on your tax books yet. In year 3, you're going to have only 35 on your books, 100 on your tax returns. So you had more book income in year 1 and year 2, and this reversed off in year 3. Guys, that's why we say it's a temporary difference. It's going to reverse off over time. So all the 3 years put together is the same number. So in year 1 and year 2, you're going to have a deferred tax liability. This is a temporary difference. And the example that I have for you is relating to construction contracts. So that was when the book income is more than the tax income. Let me give you another example. And now let's look at expenses. So we're talking about book income being more than tax income. So how about book expense versus tax expense? We need to get to book income greater than tax income, because that's a mnemonic, right? It's a deferred tax liability if it's more book income today. Book income is more than tax income. So for book income to be more than tax income, book expense needs to be lesser than tax expense. So let me give you an example for depreciation. So again, we're looking at DTL, and your example here is relating to depreciation. So you have your books and your tax return. And let us say for depreciation, you've used straight line method for books. And this is something I taught you in FAR-3, and you got to remember this. But for tax, what you do is you take accelerated depreciation. You take double declining balance depreciation, and I'll talk about makers when we're doing regulation. That's modified accelerated cost recovery system. So you have used accelerated for tax. Now let us say we bought an asset worth, let's say, $100,000 in the middle of year 1, and that's got a 5-year life. So for your books, you're going to have year 1, 2, 3, year 4, year 5, year 6. You got it in the middle of the first year, it's got a 5-year life. So first year, you've used it for half the year. So it's going to be depreciation for 10. Second year, it's been used for the full year. Third year, full year. Fourth and fifth full years. Sixth year remaining is gone off. All the 100 is depreciated over 6 years. Half in first year, half in sixth year, remaining 4 years. For tax purposes, now you don't want to use a straight line slow method of depreciation. You want to run with depreciation, accelerate the depreciation, because you want to save taxes. But you will still have a deferred tax liability, as though you'll be able to save money now, later this will reverse off. So let me pick up a maker schedule that we have for accelerated depreciation. So now, if you have a maker's personal property where you're using 200% double declining balance with 5-year recovery period, in year 1, your depreciation is going to be 20%. So since this asset is for $100,000, it's going to be $20,000 here. So 20 in year 1. In year 2, it's going to be 32%. So you have 32 here. In year 3, it's going to be 19.2%. So I'll say it's 19. Year 4, going to be 11.52. I'll say it's 12. Year 5, again, you're going to have 11.52. I'll say it's 12. And year 6, you're going to have 5.76. Let's make it 5. So this should calculate to 100 depreciation. Look at this. Over 6 years, on your books, GAAP books, and on your tax returns, you got 100 of expense for depreciation. But in year 1, on your books, you just had $10,000 of depreciation. On your tax returns, you had $20,000 depreciation. So your book expense was less than your tax expense. Naturally, because you had less expense on your books, your book income was higher. More book income, deferred tax liability year 1. Same story in year 2. You had 20 depreciation on your books, 32 on your tax returns. Book expense is less than tax expense. Book income, more. Naturally, more book income, deferred tax liability. But from year 3, this starts reversing, where your book expense is now more than your tax expense. So in the first 2 years, you had deferred tax liabilities being created, and that got reversed off by the time the asset was fully depreciated. So guys, if it's more book income, you're going to have a deferred tax liability. But this is a temporary difference which is going to reverse off over time. So that was like Miles' books, like this books. Now let's talk about you allocating more time to this books, deferred tax assets. So we're going to have DTA. Now, let's say we're looking at book income and tax income. In DTL, I said more book income today. Now we are saying more tax income. So this number is higher. Tax income more than book income. And now I'll give you an example for deferred revenue. Deferred revenue, deferrals, matching concept. Remember something we learned way back, FAR-1. So I'm going to talk about your books and your tax returns. So let's say year 1, year 2, year 3. Let's say you like this books. Now I've written them. Now I take royalties from Miles CPA review for this books. Now let's say Miles, they give me royalties for the next 3 years right now. And let's say I'm taking $100,000 of royalties every year. So I got $300,000 right now for the next 3 years. On my GAAP books, how much of income do I have? Do I have all 300 right now? No, this is deferred revenue. Deferred income, I've received it in advance. I'm going to say I've had 100 income in year 1, 100 in year 2 and 100 in year 3 as I'm going to earn. So in year 1, I'm going to have deferred income of 200, which I'm going to recognize as I earn it. I earn the 100 in year 2 and the remaining 100 in year 3. But for tax purposes, the rule is if you receive rent, royalties or interest in advance, the moment you receive it, it's income on your tax returns. So guys, on GAAP books, it's deferred revenue if you received it in advance. Tax books, you've received rent, royalties or interest in advance, recognize it as income right away, pay taxes right now. So all 300 is income here. So it's something like I should have paid taxes only on 100, but I paid taxes on 300. I paid more taxes. I prepaid my taxes. So I should have paid taxes in year 1, year 2, year 3. But they said, no. Pay us all the taxes in year 1. Prepay your taxes, deferred tax asset, more tax income. So it's a deferred tax asset which I create in year 1, which get reversed by the time I reach year 3 because it's 300 and 300. So tax, no income in year 2, no income in year 3. Now, that was the income part. Let's also look at the expense part, similar to what we've done here. So I'm going to look at DTA and I'm looking at book expense versus tax expense. I'm looking at book income versus tax income. So for deferred tax asset, I know it's allocate more time. Asset means more tax income. So tax income is more than book income. In other words, I could say book expense is more than tax expense. So here I'll give you an example for warranties, bad debts. I taught you all this, FAR-2, remember? So you had, let's say, warranties, bad debts. Now, under books and under tax. Now, on your GAAP books, you're going to have allowance for warranty expenses. So we sell the goods today. So let's say we're selling these cameras today. We're giving warranties for the next 2 years. We're selling them today. So we're going to have a warranty expense right today. We're going to create an allowance. The cash is going to go out over the next 2 years. On your books, you have an expense for allowance. But the tax guys, they say, no. Wait for the cash to actually go out before you expense it on your tax returns. So on your books, it's allowance. Tax books, they say, wait for the cash to actually go out. Bad debts. On our books, we had the allowance method. We had allowance for bad debts. So it could be a percentage of sales during the year, percentage of ending accounts receivable. You got to remember all this. But I said for tax purposes, you're allowed to use only the direct write-off method. So you got to wait for somebody to refuse you to pay before you can expense on your tax books. On your books, you create an allowance even before they refuse you to pay, because you know some of them, they're going to refuse you to pay. So here you have allowance, here it's direct write-off. So guys, putting in numbers here, let's say again I put in 5-6 years here. So let us say my allowance for warranty or my allowance for bad debts in year 1, that was 10. In year 2, it was 15. Year 3, it was 15. Year 4, it was 20. Now for tax purposes, I had this allowance. I had to wait for the cash to actually go out. The warranty expense to actually happen. I had to wait for one of my debtors to refuse to pay before I can expense it out here. So I didn't have, let's say, anything in year 1. But in year 2, I had, let's say, 10. Year 3, I had 15. Year 4, I had 15. Year 5, I had 20. So guys, as you can understand, on my books, the expense was in year 1. But on the tax books, it happened later, year 2. The expense in year 2, that happened later, let's say in year 3. The expense in year 3 on my books happened later, in year 4 on my tax books. So guys, as you can understand, I had more book expense than tax expense. So on these books, there was higher amount of expense than on these tax books. Book expense more than tax expense. That means the book income was lesser, expenses more, that means income is lesser than the tax income. So tax income was more than the book income. Now that is the case when I have a deferred tax asset, because I am paying higher taxes. I have an expense here which I'm not allowed to take here. So on my tax returns, I'm paying higher taxes right now. I'm paying taxes for something that I have not yet earned. I'm prepaying my taxes. So guys, that is why it's a deferred tax asset. So what I want you to understand here is we're looking at the income part as well as the expense part. Whenever you have a question which talks about the expense part, convert it to the income part. So when I said book expense less than tax expense, I don't understand this because this doesn't fit my mnemonic. What I'll do is I'll look at what's more, book income or tax income. So I said in this case, if my book expense is less than tax expense, book income is more. More book income, deferred tax liability. In this case, the book expense was higher than tax expense. In other, the book income was lesser than tax income, or the tax income was higher. Asset if it's more tax income. In this case, you're earning the money, you're having higher income here, but you're not paying the taxes yet. It's a liability, it's a deferred tax liability. In this case, your tax income is higher. So you've not earned the money, but you're paying out the taxes. You're prepaying the taxes, deferred tax asset. With the concepts now so very clear, let's go to the book and we'll come back and I'll give you a lovely template for you to solve all questions that you have relating to deferred taxes on your CPA exams.
On page 4, we're looking at temporary differences, and these differences, right, affects current and deferred taxes. So temporary differences occur due to items which will highlight reverse themselves in a matter of time. These are timing differences, and they affect the deferred tax computation by creating deferred tax assets and deferred tax liabilities. Now the first one, put a box around deferred tax liabilities. And the question for all of you is, do you like Miles books? So like Miles books, that means it's a deferred tax liability if it's more book income today. So right there, book income is higher, and highlight more book income today. From an accounting viewpoint, what you need to understand is the taxes have been incurred today, but they haven't been paid out. They're going to be paid out later. So it's a liability. So right there, tax incurred today, but to be paid later, which means it's liability due. Next one, put a box around deferred tax assets. So as you told me that you like Miles books, I told you you need to allocate more time to these books. So allocate more time. Assets, more tax income. So guys, right there, tax income is higher, and highlight more tax income today. From an accounting sense, these taxes, they're going to be incurred later, but you're paying them today. So it's a prepaid asset, a deferred tax asset. So right there, tax to be incurred later, but paid today. It's a prepaid asset. And to measure deferred tax assets and liabilities, you're going to use highlight future enacted rate.
Now guys, I'm going to be giving you a two-step action plan for you to calculate all numbers that are needed for deferred tax calculations. So in step number 1, what we'll do is we'll calculate the taxable income that comes in on your tax return. So naturally, we'll start with our pre-tax book income. We'll first adjust for all the permanent differences. Then we'll adjust for temporary differences which are going to reverse off over time, and that is going to get us to taxable income on the tax books, step number 1. Then in step number 2, we're going to be calculating the income tax expense on the income statement. Now that income tax expense is income tax expense current plus income tax expense deferred. How do we calculate income tax expense current? That's so simple. We're going to look at this taxable income on this income tax form, multiply it by the current tax rate. We got income tax expense current. Simple, easy. Then we're going to look at the temporary differences that we had in step number 1, and we're going to multiply those temporary differences by the future enacted tax rate, because the reversal is not going to happen now, it's going to happen in the future. So those temporary differences in step number 1, we're going to multiply it by the future enacted tax rate. We're going to calculate income tax expense deferred. So step number 1, we calculated the taxable income. Step number 2, we're going to calculate income tax expense current and income tax expense deferred. Once we have both these, simple sum, we get income tax expense on the income statement. So let me write it on the board, and I know it's going to get easy and easier for you guys. So let's say step number 1, we're starting with a pre-tax book income. So we're starting with your income statement, book income. And we have plus and minus for permanent differences. That gets us to taxable book income. The portion of the book income that is actually taxable. So guys, if you remember, those fines, penalties, bribes, kickbacks, life insurance premiums on the lives of offices where the corporation is the beneficiary, all those expenses were allowed on your GAAP financials, but they were not allowed on your tax returns. So you're moving from your GAAP books to your tax books. So you need to add them back. You subtracted them here, now add it back. Now think about those municipal bond interest, state bond interest. That was income here, but that's not taxable out here. So when you're moving from your GAAP books to your tax books, you got to less it. So guys, that's your plus minus permanent difference. So here you can look at those expenses which are not deductible for tax. Here you can look at income items not taxable. You can do taxable book income. Now you've gotten the permanent items off. They're never going to reverse off. That's permanent. Now we're looking at temporary differences. Differences which would reverse off over time. So we're going to have plus and minus even for temporary differences. And after we've adjusted for both the permanent and the temporary differences, we're going to get to taxable income. That's the number on a tax return. So guys, let's analyze this. I'm looking at my book income here and my tax income here. I'm making it so much more animated for you guys. So it's book income here, tax income here. Now, when would we add permanent temporary differences? We would add temporary differences when the tax income needs to be more than the book income. That means more tax income today. Guys, more tax income today. That's your deferred tax asset. So this temporary difference, this would create a deferred tax asset. We're going to multiply this temporary difference by the future enacted tax rate and calculate deferred tax asset. So this one relates to deferred tax asset. Now the animation once again. GAAP books, tax books. When would we subtract temporary difference? When this one is more than this. We're going to subtract temporary difference only when your GAAP books are more than your tax books. That means this is a deferred tax liability because it's more book income today. So you could say this one, these temporary difference, they relate to DTL. So guys, now I can very safely say the temporary differences which create deferred tax assets are added in step number 1. The differences which create deferred tax liabilities are less in step number 1. So this is add, this is less. Deferred tax asset A, add. Deferred tax liability L, less. Step number 1. So step number 1, we have safely gotten to the taxable income on our tax return. Now we're looking at step number 2, where we're calculating the income tax expense that goes on to the income statement. So income tax expense, that's the sum of income tax expense current and income tax expense deferred. Income tax expense current, we're going to use this taxable income that we have here. So we're going to use this taxable income, multiply it by the current tax rate. That's what we do on a tax return, right? So once we get to a taxable income, we calculate the total tax. How do we do that? By multiplying it by the current tax return right today. Now, for income tax expense deferred, we are looking at both deferred tax liabilities and deferred tax assets. So it's going to be plus deferred tax liabilities, because it's something like income we've earned today, but we haven't paid the taxes. We've got to increase the expense. Deferred tax assets, that means we have not yet earned the income, but we have prepaid the taxes. So guys, these temporary differences that created DTL here, they were minus here. Now it's coming in here. Let me use the blue pen. So this temporary difference, when you multiply it by future tax rate, you would get the deferred tax liability for the year. These temporary differences which related to DTA, again, when you multiply it by the future tax rate, you're going to get DTA. So this was the entire amount of temporary difference. Now you got to multiply it by the tax rate to get your income tax expense deferred. You're looking at deferred tax liability for the year. We are looking at deferred tax asset for the year. Now, once you have all these three numbers in place, it's simple. Income tax expense current plus income tax expense deferred, or you could say income tax expense current plus DTL for the year minus DTA for the year, plus the deferred tax liability for the year minus the deferred tax asset for the year. So the temporary difference that created deferred tax asset was add in step number 1. And the actual deferred tax asset dollars is less in step number 2. The temporary difference that created deferred tax liability was less in step number 1. And finally, when you calculated the deferred tax liability dollars, that's an add. So guys, you could use any way that you like. Conceptually very sound. You might not need to know the way I'm doing it here, but it's very handy on the exams. So whenever you have a question, they'll ask you to move from book income to tax income, and then they'll ask you to calculate your income tax expense that goes on your income statement. So if you know this template, you can draw this on the scribble paper that you have, just fit in the numbers. Look how easy it's going to become now. So now I'm going to look at an example that I have on your book, and we're going to just plug in the numbers, and this template is going to be all set, all good to go. So looking at the example here, we have A company and L company. We're looking at two companies here. First, looking at the A company, they had pre-tax book income of $750. Now, they had paid certain fines and penalties for $75. Now, that's an expense here, not allowed here. Permanent difference. Expensed it out here, now you got to add it back to reach here. So, plus permanent difference 75. Next, they had some muni bond interest of 25. So that was income here. But that's not an income here. So to move from your GAAP books to your tax books, you need to less it, minus 25. So that gave you the taxable portion of the book income. So 750 plus 75 minus 25 gives you 800. Now, they had certain rent received in advance. So rent received in advance. The IRS, they have their eyes on their advance rate. But for GAAP purposes, you're going to be wait till you earn the rent. So you've received it in advance. For tax purposes, you're going to pay the tax. GAAP purposes, you haven't earned it yet. So it's not included in your GAAP books, but on your tax books, you're going to include it. It's more tax income today. You're going to add it to your GAAP books to reach your taxable income. So we are adding the rent received in advance of $100. That gets us to taxable income 900. So that was all step number 1. Now we're looking at step number 2 next. So So green pen, so this one is step number 1 and this one is step number 2. So on step number 2, we'll first calculate the income tax expense current for this year. So this year on the tax return, it's $900. Tax rate for this year, it's 30%. So $900 into 30%. So 900 into 30% gives me 270. That's the income tax expense current to be paid to the IRS, to be paid to Uncle Sam this year. Now we're going to make adjustment for deferred taxes. Now this was a temporary difference which relates to deferred tax asset that was added in step number 1. In step number 2, this was a prepayment, right? So ideally we should have paid taxes only on 800. But we paid taxes on 900. We prepaid taxes. So on our income statement, we got to reduce this number to the extent of the deferred tax asset. So let us say if the future enacted tax rate was also 30%, what we would have done was we would have taken this 100, it becomes negative here, 100 into 30%, negative 30. Let me create a little more space out here. So DT, let me leave it deferred. Rather, I'll do this for deferred and minus DTA. I'll have this for DTA. Makes sense. Now, so if the future tax rate was also 30%, we would have minus 100 into 30% would have given us minus 30 here. So what would have been the tax expense that goes into your income statement? So that would have been 270 minus 30, 240. Now look at this, 800 into 30%, 240. So guys, actually we should have paid taxes on what we have earned during the year. But we paid some excess taxes. We paid taxes as per the tax return. Now for our GAAP books, now we subtract the excess taxes, the prepayment, and we get to this 240 number which is expensed on the income statement. Now in this example, the future enacted tax rate is not 30%, it's 40%. So basically, we have paid taxes right now 30%, but we're going to be saving more later. We're going to be saving 40% later. So instead of 30%, which is the current tax rate, we're going to use future tax rate, which is 40%. So that makes it minus 40. So the income tax expense for a company for the year is 270 minus 40 gives you 230. Simple, easy. Just use this template and you'll be all set for deferred tax calculations. Let's look at L company. So L company, they had pre-tax book income of 500, permanent difference plus 50, permanent difference minus 100. So this plus 50 was due to life insurance premium that they had paid out, which was an expense here, not allowed on this, added back. The minus permanent difference was due to life insurance proceeds that they had received when one of the officers died. So that's income here, not income on your tax books. So subtract it, minus 100. This gets you to the taxable portion of your book income, which is 450. And then you had, okay, in this case you had excess depreciation for tax. For tax purposes, they used accelerated depreciation. So on the GAAP books, it was slow depreciation. But on the tax returns, it was accelerated depreciation. So on the GAAP books, you have to subtract more to reach your taxable income. So that's the subtract of $50. Guys, this means more book income today. More book income today, like Miles books, so it's a deferred tax liability if it's more book income today. So this negative temporary difference, this relates to a deferred tax liability. So we're done with step number 1. Let's look at step number 2 now. So in step number 2, we'll first look at income tax expense current. So for income tax expense current, we're looking at the taxable income into the current tax rate. So 400 into 30% gives us 120. So that's your current tax expense. Now, DTL, deferred tax liability, that's a minus here, it's a less here in step number 1. In step number 2, you got to add it back because it's a liability for you. So 50 into, let's assume the future enacted tax rate is also 30%. Let's do it that way. So we have plus, so 50 into 30%, which gives us plus 15. So this would be 120 plus 15, 135. So guys, if you had multiplied this 450 into 30%, that would have given you 135. Look at the same thing here. 800, if you had multiplied by 30%, you would have gotten 240. 450, if you had multiplied by 30%, you would have gotten 135. But it says in this problem, the future enacted tax rate is different. So we'll use a different rate. So we'll use 40% for the future enacted tax rate. So 50 into 40%, that gives you 20. So 120 plus 20 gives you 140. So guys, that is all your template to calculate your taxable income first in step number 1. So step number 1, your focus is you're looking at calculating taxable income. In step number 2, you're looking at calculating the total income tax expense. You're looking at current and deferred. So income tax expense current plus DTL minus DTA. Another reasoning for this plus and minus, let's look back here. So you had your income tax expense deferred debit DTL credit. So for the L company, you're going to have income tax expense deferred of 20 or DTL of 20. For the A company, we had DTA of 40 and income tax expense deferred same 40. So guys, because deferred tax asset was created, we reduced the income tax expense. It was a minus. Because a deferred tax liability was created for L company, we increased income tax expense plus for TTL for the year. So guys, it's a lot of ways for you to understand this. I'll just do a quick recap here so that this concept really sinks in. You're very comfortable with what we're doing here. So what I would tell you is, whenever you have any problem on your CPA exams relating to deferred taxes, first ask yourself, do you like Miles' books? If you do, allocate more time. So this is what you ask yourself. So step number 1 is ask LMBAMT. Now you know whether it's a temporary difference creating a deferred tax liability or a deferred tax asset. After you're set with this, then you go on for your 2-step action plan. So now it's time for you to act. So after you've asked, it's time to act. So when you act, 2 steps, 2-step action plan. Step number 1, from your pre-tax book income, you get to your taxable income. You do adjust for permanent differences and temporary differences. Step number 2, you're calculating your income tax expense for the period. Now, you're looking at income tax expense current, that's your taxable income into current tax rate. The last number here into the current tax rate. Simple, easy. Then, when you're looking at deferred tax liabilities and assets, look at the temporary differences. The temporary difference that relates to deferred tax assets here, it was an add here, would actually become a deferred tax asset for the year, would be less here. The temporary difference that created the deferred tax liabilities, you got to multiply that again by the future tax rate, would become a deferred tax liability for the year. It's an add here. So for A company where we had deferred tax asset, the deferred tax asset helped you reduce the income tax expense, less here. For L company where you had a deferred tax liability, that was a plus out here. So guys, that is all you need to know for deferred taxes. Now we'll get to the book, look at this example, and then we'll come back with another comprehensive example, and I'll make sure you nail this concept.
Now, I've given you a lovely trick to account for temporary differences between your GAAP books and your tax books. These temporary differences, they could create a deferred tax asset or a deferred tax liability. So the first thing that you do is you ask whether it's a case of a deferred tax asset or deferred tax liability. So circle ask and underline DTA or DTL. So use my mnemonic for answering this. So the question is, do you like Miles books? If you do, allocate more time. So like Miles books, so it's a liability if it's more book income today. Allocate more time, so it's a deferred tax asset if it's more tax income today. Now after you've asked yourself the question, now it's time to act, and I give you a two-step action plan. So circle act, put a box around step 1, highlight taxable income. So now you're calculating the taxable income. In other words, you're moving from book income to tax income. So you start with book income. First, you adjust for all permanent differences. Then you adjust for temporary differences. And highlight difference creating DTA, add. Difference creating DTL, less. And put a box around that because this is very important for you to remember. So DTA, asset difference, add. DTL, a liability difference, less. So this way you calculate your taxable income. Now it's time to move on to step number 2. So put a box around step 2. And in this step, we are calculating highlight income tax expense. And we're looking at income tax expense, current plus deferred. So income tax expense current, that's the taxable income on your tax returns into the current tax rate, because that's something which you're paying right now. Next one, income tax expense deferred, and write there later because that's a temporary difference. Now it could be a deferred tax liability or a deferred tax asset. So when you're calculating your income tax expense, it's a sum of your income tax expense current and income tax expense deferred, or in other words, it is highlight income tax expense current plus deferred tax liability for the year minus deferred tax asset, and put a box around this calculation. So guys, in step number 1, when you were calculating taxable income, differences that created deferred tax assets, you added. Differences that created deferred tax liabilities, you subtracted, less. Now in step number 2, when you're calculating the income tax expense, then you're looking at the current expense plus deferred tax liabilities, something that you've incurred but not yet paid, minus deferred tax asset, something that you have not yet incurred but have prepaid. Now turn on to page 6 where you have my template to calculate the income tax expense, both current as well as deferred, and you would also calculate the deferred tax asset and the deferred tax liability. So guys, I give you a two-step action plan. So right there, step number 1, calculate taxable income. So you're moving from your financial, your book income, to your tax income. Highlight income statement, financial or book income. So this is your pre-tax book income. You adjust for permanent differences, plus or a minus gives you the taxable book income, and then you adjust for temporary differences, could be a plus or a minus. Put a bracket there and write difference which creates DTA, add. Difference which creates DTL, less. And this way you get to highlight taxable income. So that's on your tax books. Then the second step, step 2, calculate income tax expense. So income tax expense for the period is the sum of your income tax expense current plus income tax expense deferred. Now first looking at the income tax expense current, that's the taxable income on your tax returns into the current tax rate. So guys, right, use taxable income on your tax books to calculate current taxes. Now the next one, income tax expense deferred. That's deferred tax liability minus deferred tax asset for the year. So right, use temporary differences to calculate deferred taxes. And put a bracket on the right and make a note. DTA dollars less. DTL dollars add. The trick here is to understand that a difference creating a deferred tax asset is added in step number 1 where you're calculating taxable income. Now that difference is multiplied by the future enacted tax rate, which calculates to deferred tax asset. Now the deferred tax asset for the year, that dollar, that's less when you're calculating the income tax expense. Whereas a difference creating a deferred tax liability is less in step number 1 where you're calculating taxable income. Now that difference gets multiplied by the future enacted tax rate to calculate the deferred tax liability for the period. And deferred tax liability for the period that you've calculated is add when you're calculating your income tax expense in step 2. So guys, in step number 1, when you're moving from your financial book income to your taxable income, you need to remember that you're adding all differences that create deferred tax assets, you're subtracting or less all differences that create deferred tax liabilities. But in step number 2, when you're calculating the income tax expense, you're taking first the income tax expense current, then you have plus or add for deferred tax liabilities and less for deferred tax assets. Now from an accounting viewpoint, what you need to understand is when we're looking at deferred tax liabilities, those are basically taxes that you've incurred today, but you're going to pay them later. Now because you have incurred those taxes today, we're going to expense it today on your financial books. Deferred tax assets, now those are taxes that are to be incurred later, but you've paid them today. It's a prepaid asset. Now that's not an expense on your GAAP books till you actually incur it. So you're going to subtract it to calculate the income tax expense. On page 7, we are looking at our example on deferred tax assets and liabilities. So you got two columns there, A company and L company. For A company, we're talking about DTA or deferred tax assets. For L company, DTL. On the left, step number 1. Because in step number 1, we are calculating the taxable income. So we move from the pre-tax book income to taxable income. So we do plus and minus permanent differences and then plus and minus temporary differences. For A company, we're going to have a deferred tax asset. The temporary difference that's creating the deferred tax asset is added. So highlight 100 and write add difference. For L company, the temporary difference that creates the deferred tax liabilities is less in step number 1. So highlight a negative 50 and write less difference. And put a box around taxable income. Because in step number 1, our purpose is to calculate taxable income. Then we move on to step number 2. And first we'll calculate income tax expense current. And for that we're going to use underline current tax rate. So we use taxable income into current tax rate to calculate income tax expense current. And a journal entry for that is income tax expense current debit and the credit is income tax payable. So highlight the debit income tax expense current. And for income tax expense calculations, the current is a plus. So write plus current. For income tax expense deferred, we're going to use underline future enacted tax rate. For a company where the temporary difference was $100, we multiply by the future enacted tax rate of 40% gives us $40. So look at the journal entry. The debit is to deferred tax asset account, which goes to the balance sheet, right? B/S. The credit, highlight income tax expense deferred and write I/S. Now since the income tax expense account is credited, we know that income tax expense is getting reduced by the deferred tax asset for the year. So write minus DTA dollars. So once again, the temporary difference that created this deferred tax asset, the temporary difference of $100, that was an add when we calculated taxable income in step number 1. In step number 2, the actual deferred tax asset for the year, $100 into 40%, $40, that's less when we are calculating the income tax expense. Whereas for deferred tax liability, the difference in step number 1, that was $50. Now we're going to multiply that difference by 40% future enacted tax rate gives us $20 of deferred tax liability for the year. Now looking at the journal entry, the debit is to highlight income tax expense deferred, write I/S, and the credit is to deferred tax liability, which goes to write B/S balance sheet. Now since the deferred tax liability for the year results in a debit to income tax expense deferred, we know that the income tax expense actually increases on account of the deferred tax liability. So write plus DTL dollars. So guys, in step number 2, the income tax expense is equal to the income tax expense current plus deferred tax liability for the year minus deferred tax asset for the year. So let's look at the calculations there. Put a box around total income tax expense on income statement. For a company, income tax expense current, that's $270. Deferred tax liability, 0. Deferred tax asset, -40 there. So 270 minus 40, highlight minus 40, gives us 230. And right there, less DTA dollars. For L company, the income tax expense current, that's 120. Plus DTL dollars, that's $20. Minus DTA dollars, that's 0. So 120, highlight plus 20, gives us 140. And right there, add DTL dollars. So guys, once again, deferred tax assets for the year, that's paid today. That's included in income tax expense current. But that's not incurred today. So we take it out of the income tax expense current. Deferred tax liabilities, that's incurred today but paid later. That's not included in our income tax expense current. So we add it to income tax expense current to get the income tax expense which goes to the income statement. Now let's summarize all the methods that we're using in calculating deferred tax assets and liabilities. So right, ask, and you want to ask, is it a DTA or DTL? And we're going to use our mnemonics here, right? Like Miles books. So right, DTL equals more book income today. And if you like Miles books, you know you need to allocate more time. And right, DTA equals more tax income today. So LMB, that is liability if it's more book income today. AMT, so it's an asset if it's more tax income today. So after you understand whether it should be a deferred tax asset or a deferred tax liability, it's time for you to write ACT. And your step number 1, right, temporary difference due to DTA equals add. Temporary difference due to DTL equals less. So now after you've adjusted the differences, the permanent differences and temporary differences, you get to taxable income in step number 1. Now in step number 2, you're calculating the income tax expense which goes to the income statement. So on your deferred tax expense current, you're going to less DTA dollars for the year and add DTL dollars for the year. So right, DTA dollars equals less, DTL dollars equals add.
Now, we'll look at a comprehensive deferred tax example on your book. It says, DT company reported $500,000 of pre-tax financial income with the following inclusions. So $500,000, that's your book income before tax. That includes $25,000 of life insurance premiums for policies on which the corporation is the beneficiary. That's a permanent difference between GAAP books and your tax books, permanent difference. Interest income on muni bonds of $125,000. That's income for GAAP purposes, not for tax purposes. So that's again a permanent difference. Next one, product warranty costs of $50,000 to be paid out in future years. So on your GAAP books, that's an expense right now. Tax books, not an expense now. It's going to be an expense only when it's paid out in the future. So that's a temporary difference. Next one, book depreciation less than accelerated tax depreciation by $75,000. Again, a temporary difference between GAAP books and your tax books. So we're looking at what amount should DT company report on the income statement for federal taxes, assuming a 30% current tax rate and a 40% future enacted tax rate. So let's try to solve this right here. Now, before we start solving it, now I told you first, ask and then act. So the first two items, we know they are permanent differences. Let's look at the temporary differences. Now, product warranty costs of $50,000 to be incurred in future years. So on your GAAP books, it's an expense. On your tax books, it's not an expense yet. So your tax income would be higher than your GAAP income. More tax income today, allocate more time. More tax income today means it's a deferred tax asset. So that is a temporary difference which would create a deferred tax asset. So that's add above the line in step number 1 and less when you're calculating income tax expense. Next difference, next temporary difference. Book depreciation less than accelerated tax depreciation by $75,000. So on the books, you're depreciating slowly, but here you're really doing accelerated depreciation. So your book income would be higher than your tax income. More book income today, that's a deferred tax liability. So deferred tax liability would be less in step number 1. And when you get to step number 2, when you're calculating your income tax expense, you are going to add the deferred tax liability for the year. So now with this ask done, we've done the questioning ask. Now it's time for us to act. And I have a 2-step action plan for you right here. Let's do it. So I'll be quickly plugging in the numbers and guys, you'll enjoy this ride. So pre-tax book income 500. Now you had certain expenses not deductible for tax. What's that? That's $25,000 life insurance premiums. Add them. You had certain income on your GAAP books which the tax guys don't look at. So that's the tax exempt interest on muni bonds. So you got to reduce that from your pre-tax book income to get to taxable book income. So this is the portion of the book income which the tax authorities are concerned with now or in the future. So this is minus 125 gives you 400. Now we're looking at temporary differences. Now we've already discussed the temporary differences. We know the product warranty, that's a temporary difference which is creating a deferred tax asset. So that was add in step number 1. So in step number 1 we're going to have add for 50 and we're going to have less for the accelerated depreciation that we used for tax purposes. So that was less for 75. Now this gives us taxable income of 375. Now we set to go to step number 2. Step number 1 done, good. Step number 2, calculating the income tax expense for the period. First we look at income tax expense current. So we'll have this 375 multiplied by the current tax rate 30%. That gives us 112,500. So let me call it 112.5. Then DTL. So what was the temporary difference which created DTL? That was less above the line. That was the depreciation part. Now below the line in step number 2, we're going to add it. So 75 is going to be multiplied by the future enacted tax rate of 40%. So we're going to have 75 into 40% and that is going to be an add. So the add is 30. Now the temporary difference creating the deferred tax asset which was added here now would be a less in step number 2. We're going to multiply this 50 by the future enacted tax rate of 40%. So we're going to have 50 into 40% gives us minus 20. Guys, deferred tax asset temporary difference add above the line. The actual deferred tax asset that will help you reduce the income tax expense because that's a prepayment of tax. So now 112,500 plus 30 minus 20. This gives you 122,500 of income tax expense. Now let's go on a dashboard and put these numbers on the journal entry and on our financial statements. So this is financial accounting, that's reporting. So if I'm looking at the deferred tax liability, that was for $30,000. So it'll be 30. Deferred tax asset, that was for 20. Now for the current income tax, so that's something which is payable to the IRS, payable to Uncle Sam right away. So it could have been payable or it would have been cash paid out. So that's the current portion. Now on the income statement, we're going to have the current tax 112,500 plus the deferred tax liability portion 30 minus the deferred tax asset portion 20. So that's deferred tax liability and asset for the year. This calculates to 122,500. Now on the balance sheet, we'll have this deferred tax liability going in 30,000 and we'll have the deferred tax asset going in for 20,000. Now for the income tax expense current, either you've already paid out cash or it could be a current liability on your balance sheet. So that depends on whether this has been paid out yet via estimated payments during the year or it's yet to be paid out. So guys, that is all that you have for deferred tax calculations. Remember, first, before you start, it's better that you ask. You look at the mnemonic, like Miles' books, allocate more time. It's a liability if it's more book income today. It's a deferred tax asset if it's more tax income today. So now you're set with permanent differences and temporary differences. So you know which temporary difference create a deferred tax liability and which temporary differences create deferred tax assets. Then you write this template down, simple, easy, 2-step action plan, and you are good to go.
On page 8, looking at the solution to a comprehensive example on deferred tax. So the first part of the solution, that's right, step number 1. We'll be moving from the pre-tax book income to the taxable income. So highlight taxable income. Then we go on to write step number 2. if you're calculating, highlight income tax expense. Now, income tax expense for the period, that's equal to the income tax expense current plus deferred tax liability for the year minus deferred tax asset for the year. So looking at the journal entries there, on the first journal entry, you have income tax expense current on the debit, right? I/S. Second journal entry, you have income tax expense deferred on the debit, right? I/S, and the credit is to deferred tax liability, right? B/S. Third journal entry, deferred tax asset is debit, so that goes on to, right, B/S balance sheet, and the credit is to, right, I/S income tax expense deferred. So now it comes out much more clearly why income tax expense current is an add, deferred tax liability for the year is an add, and deferred tax asset for the year is a subtract when we are calculating income tax expense for the period.
Now let's talk about a few complications that you could have when you're accounting for taxes. Now let's say you have certain deferred tax assets on your balance sheet. You've prepaid those taxes. But now you're unsure if you'll have enough income in the future to use those prepayments. Now the IRS, the Internal Revenue Services, they won't return you your cash back. Therefore, if you can't use it, you don't want to overstate your assets on your balance sheet. You would want to create a valuation allowance account, a contra asset to this deferred tax assets, so that you reduce this number on your balance sheet. The second complication that we'll talk about here is tax rate changes. Now, we've used a future enacted estimated rate of 40% here. What if these rates change? It becomes 35% or it becomes 45%. Now, in that case, you would adjust your deferred tax assets and your deferred tax liabilities, both of them in the year of change. Now, think of it as a change in estimate, and you guys know change in estimate, that's to be accounted for prospectively, now and forward. Okay, the third complication, we're talking about, let's say, uncertain tax position. Now, we might have taken certain deductions on our tax return, but we are uncertain whether it's okay or the IRS, they're going to come back and disallow them later. So now what we must do it is on our financial statements, we must record an income tax liability for the excess tax savings or tax benefits which we think may not be realized if the IRS comes back later.
On page 9, highlight valuation allowance account. So for deferred tax assets, we know that they are tax prepayments. So we pay out the taxes today, though we're going to incur taxes in the future. Now let us say we're not sure that we would be able to generate enough income in the future to be able to use these deferred tax assets. Now in that case, we do not want to overstate the deferred tax assets. And that is why we create a valuation allowance account, a contra asset to those deferred tax assets on the balance sheet. So right there, create if unsure of future income to use DTA. Now looking at the example there, it says considering facts in the previous example regarding deferred tax assets, if DT company expects to have a taxable income of only $40,000 in the next year and no taxable income thereafter, what would be the valuation allowance? Now in that case, the deferred tax asset should be limited to the $40,000 taxable income into 40% future tax rate, $16,000. But we created a deferred tax asset of $20,000. That is why we're going to create a valuation allowance account, a contra asset to those deferred tax assets for $4,000. Look at the journal entry there. Income tax expense deferred $4,000 and the credit is to deferred tax asset valuation allowance for $4,000. Now let's look at another issue of tax rates changing from year to year. So right there, tax rate changes, and this means that we need to adjust DTA and DTL in the year of change. So if the tax rate changes, account for it prospectively, now and forward. Turn on to page 10, where we're looking at uncertain tax positions. And our worry here is that IRS may disallow deductions later. So we might have taken deductions for expenses and losses. And our worry here is that IRS, the income tax authority, they may disallow those deductions and ask us to pay income taxes on them. Now GAAP requires more likely than not level of confidence to account for such uncertain tax benefits on the financial statements. Now we're going to look at a two-step process here. Highlight step number 1. We're going to test if the tax benefit was more likely than not to be sustained if the dispute with the taxing authority were taken to underlined court of last resort. Then we go to step number 2. Highlight step number 2, recognize the largest amount of tax benefit which has greater than 50% probability of being realized upon settlement with the taxing authority, and underline settlement. So guys, in step number 1, we are looking at will we be able to sustain this dispute when we go to court? But do we want to go to court? No. So in step number 2, we're going to look at what is going to be the tax benefit, the largest amount of tax benefit that we think we'll be able to have if we do a settlement with the taxing authority instead of going to court. So in step number 1, we made sure if you go to court, we'll sustain it. But in step number 2, we didn't go to court, we settled it with the taxing authority. Let's look at the example on uncertain tax positions. So Fishy Company has taken a tax deduction of $5,000, resulting in a $2,000 tax savings or benefit based on a 40% tax rate. Now Fishy believes that the tax deduction would have a greater than 50% probability of being sustained in a court of last resort if it is disputed by the taxing authority. So guys, step number 1, that sounds good. Fishy would be able to sustain it in court. But does Fishy want to go to court? No. So in step number 2, we're going to look at what's going to happen if Fishy tries to settle it with the taxing authority. So it says, further Fishy concludes that the following outcomes may result if a settlement was negotiated with the taxing authorities. So we have potential outcomes and the probability for each outcome. And look at the solution where we have another column for cumulative probability. So it is 40% probable that Fishy is going to have all the $2,000 as savings. It's 25% probable that Fishy is going to have $1,500 savings. Now if we add 40% and 25%, that gives us 65%. And we can say there's a 65% probability that Fishy would have at least $1,500 savings. So guys, based on Fishy's assessment of possible outcomes, Fishy should recognize a tax savings or benefit of $1,500, which represents the largest benefit that has a greater than 50% likelihood of being realized when settled with the taxing authority. And the remaining $500, that should be recorded as an income tax liability because this may not be realized.
All you future CPAs sitting out here, you've knocked off the concept on accounting for deferred tax assets and liabilities. You're very sure of how to calculate all these. Now, you also need to know how to present the deferred tax assets and liabilities on the balance sheet.
It's on page 11 that we're looking at the balance sheet presentation of deferred tax assets and liabilities. And something you got to remember is that deferred tax assets and liabilities are highlight always non-current. So the classification for these deferred tax assets and liabilities is always non-current on your balance sheet. So that could be right, maybe non-current deferred tax asset or a non-current deferred tax liability. Now, IFRS always had this requirement to classify deferred tax assets and liabilities as non-current. However, US GAAP earlier had a current and non-current classification, but FASB's recent accounting standards update makes it mandatory to classify as non-current. So now both US GAAP and IFRS have the same rules, requiring classification of deferred tax assets and liabilities as non-current. Another point that you want to remember here is regarding highlight netting of deferred tax assets and liabilities. So both GAAP and IFRS allow separate netting of deferred tax assets and liabilities, which results in circle single and right there net, highlight non-current amount which is reported on the balance sheet. Look at the example that we have here. So there's a net company which is the following temporary differences. So they have a non-current deferred tax asset of $300, non-current deferred tax liability of $200. The net is a non-current deferred tax asset of $100. Now underline, under IFRS, you're allowed to do this netting of non-current deferred tax assets and liabilities only if the amounts relate to the same taxing authority. That's basically the same country.
If you have a net operating loss on your tax return, the IRS, they allow you to carry it back 2 years and carry it forward 20 years. Now, carry back means if you had paid income taxes over the last 2 years, you can get them back as a refund. Now, that sounds good, right? You have a loss today, you can carry it back the past 2 years and take back the income taxes that you had paid to the IRS. But let's say even after the carryback, you have some more losses, then you can carry them forward over the next 20 years. You can also elect to forgo the carryback, forget the refund and take it forward only. Now guys, the carry forward would result in a future tax benefit and we'll recognize this expected future benefit as a deferred tax asset. But remember, whenever you're recognizing these deferred tax assets, you need to use the future enacted tax rate. We're looking at net operating losses on page 12. Now for tax purposes, these net operating losses can be carried back 2 years and carried forward 20 years. So right there, NOL carried back 2 years and a forward arrow, right, 20 years. Now, if these net operating losses are carried back, they reduce the taxable income in those periods, resulting in an income tax refund receivable. So we paid taxes over the last 2 years. Now we're going to be getting a refund of those taxes, an income tax benefit for us. But if a net operating loss is carried forward, they're going to result in tax savings in the future. So they are recognized as deferred tax assets. So highlight, tax carry forwards should be recognized as deferred tax assets in the period they occur, because they will reduce taxes in the future. So let's look at the example here. It says NOL company had net operating loss in 2010 as per table below. Past journal entries for NOL carry back and carry forward. So we have 2007, 8, 9, 2010, 2011. 2010, there was a net operating loss of $500. Now that can be carried back 2 years and used to offset the prior year's income for 2009 and for 2008. For 2009, it's $250.
2008 it's $100. So you can use this $500 net operating loss in 2010 to the extent of the income that was there in 2009 and 8, $350. The remaining $150 that could be carried forward. Now the tax rates for 2008 and 2009, so 2008 it was 25%, 2009 it was 30%. So that would result in an income tax refund of $100, $75 for 2009 and $25 for 2008. The balance $150 which is carried forward would result in a deferred tax asset of $60 because 150 into the future enacted rate 40% would result in tax savings of $60. So look at the journal entry there. We have an income tax refund receivable $100 from the carry back, a deferred tax asset of $60 from the carried forward, a total income tax benefit of $160.
I'm sure you guys are all having fun learning about this fun and exciting concept of deferred taxes. And the last topic that I'm going to cover here is about investments where we could have undistributed dividend. Now, for income tax purposes, you can file consolidated tax returns only if you own over 80% in the investees or the subsidiaries. Up to 80%, you can use only the cost method. That means only the dividend received from the subsidiary is considered income for the corporation. We are not concerned about undistributed earnings. Now, we know that under GAAP, the moment you own over 20%, such that you have a significant influence over the investee, or you actually control the investee if you own more than 50% of the investee, then you recognize on your income statement all of the earnings of the investees, which includes distributed dividend, what they have given out, and also undistributed earnings. As you know that even the undistributed portion will be distributed in the future, and you've got significant influence or even control to extract those undistributed earnings. Now this results in a temporary difference because your book income has the distributed dividends from those investees plus the undistributed earnings. Your tax income, unless you own over 80%, your tax income only includes the distributed dividends. So your book income is higher because it includes distributed and undistributed. Tax income only distributed. Guys, more book income. That's a deferred tax liability. This is a temporary difference. As you know, it's going to come in the future. But for now, this is a deferred tax liability as it is more book income today. Now, that was one part of the story. The twist in the tale is that for tax purposes, you have a deduction called DRD, or the dividend received deduction. And let me talk about that. Let me give you the concepts behind that. So just create a little space on my dashboard. And let us say we got a corporation and we have corporation A. So we'll use this part for DRD explanation. And they have some earnings before taxes. They pay out taxes, and that gives you the net income of the corporation. Now, let's say this corporation is held by a couple of individuals. You have individual X and individual Y. Now, after the corporation earns the net income, so they've already paid out tax, so it's after tax net income, they distribute this out, either a portion or the entire amount of net income, to the individuals. Now, for the individuals, it is dividend coming in. Now, the individuals again pay tax on the dividend income. So the corporation, they've paid taxes on what they've earned. The individuals, they're paying second taxes. Guys, this is double taxation. So individuals get dividend income and they again pay taxes on that. So this was tax number 1. This is tax number 2. Double taxation That's fine, can't help it. Now think about it. Now if we have another corporation owning stake in corporation A, let's have corporation B here. Now, so you have these two individuals plus corporation B owning stake in corporation A. Now corporation A is also paying out dividends to corporation B, one of its shareholders. So corporation B would have dividend income and they would again pay tax on this. Corporation B would also have individual shareholders, let's say individual M and individual N. Now, after corporation B has calculated its net income, it will again distribute out dividends to the individual stockholders that it has. So these individuals would have this net income going out as dividend income and they would also be paying tax on that. In the first case, we had double taxation. Corporation A paid a tax, the individual stockholders paid the second level of tax. But now look at this expansion that I have. Corporation B owns stake in corporation A. It gets dividends from corporation A. Now it pays the second level of taxes on that. And when corporation B distributes out dividends to its stockholders, there is a third level of taxation. Now, if you have another corporation, corporation C owning corporation B, then you would have quadruple taxation. That doesn't sound good. One income earned by one corporation and taxes at so many levels. Now, what the IRS, what Uncle Sam said was, we are happy with double taxation. We are happy taxing this corporation and then the individuals who get dividend income. But if there are corporations in between, we would give them something called a dividend received deduction. So what happens is, if corporation B owns more than 80% of corporation, then it can consolidate the returns. The moment returns are consolidated, there is no dividend income because intercompany dividends are excluded. So you could say, if corporation B owns more than 80% of corporation A, there is 100% DRD. There is no tax on this dividend income. Now, if corporation B owns 20 to 80% of corporation A, then it is 80% DRD. Now, what that means is, let us say corporation B has received dividend of $100. 80% DRD. What is 80% of 100? 80. That's a deduction of 80%. How much is remaining? 20. So corporation B would pay taxes only on 20, not on the entire 100 dividend received. So that's dividend received deduction. If corporation B owns, let's say, less than 20% in corporation A, then the DRD is 70%. Then it would be 100 minus 70, they would pay taxes on 30. So guys, once again, if it's 0 to 20%, up to 20%, then it is 70% DRD. If it's 20% to 80% stake, then it is 80% DRD. DRD is this deduction that I have, dividend received deduction. But if it's over 80% stake, if corporation B owns more than 80% of corporation A, then it is 100% DRD, because then you have consolidated tax returns. So in that case, it would be 100 minus this 100, no dividend income being taxed. So guys, this is an important concept for you to understand, especially when we have deferred taxes. Now think about corporation B owning 20% to 80% of corporation A. In that case, you would have 80% DRD, 80% dividend received deduction on the tax return. But on the GAAP financials, we don't have anything, we don't know anything about DRD, dividend received deduction. So guys, this one is a permanent difference. So this permanent difference is such that the income on the GAAP books is high and it's lower income on the tax books. So from the GAAP books, you need to less these items of permanent difference, this DRD. Now, for a more comprehensive understanding of the permanent differences created due to DRD as well as the temporary differences created due to undistributed dividend, let's look at an example that we have on a book. So it says Dive Company owns 40% in Pool Company and uses the equity method per GAAP. Past journal entries for income tax expense: if Pool Company had a net income of $2 million and declared dividends of $1.2 million. Assume tax rate of 30% and applicable DRD of 80%. That's right. So if the investor owns 40% in the investee, that is 80% DRD. So we're good with that. And it's given tax rate of 30%. So we'll assume that both the current and the deferred, the future enacted tax rate is 30%. So let's get there. What we would do is we'll use the same template that I have for these calculations. So we have A company, L company, T company, and now we are having Dive company. So this says Dive company owns 40% in Pool company, and Pool company has a net income of 2 million. So what's Dive's share of that 2 million? 40%. So 40% of 2 million is $800,000. Now, for tax purposes, Dive company has 80% DRD. 80% of all this money, if it comes in as dividend, would be eligible for the reduction. Now, under GAAP books, there's nothing called DRD. So that's a permanent difference. So on the GAAP books, it's going to be higher. There's no DRD, but there is DRD here. So you got to subtract it from GAAP books, a negative permanent difference, to get to taxable book income. What portion would be taxable now and in the future? The taxable portion. So we need to get this 80% DRD, this permanent difference, off first. So 80% of $800,000. So 80% DRD means a negative permanent difference of $640,000. So that leaves us with $160,000 that in total would be taxable to Dive company on their income tax returns. Now, if we look at this, the earnings were 2 million, but the dividend declared by Pool company is only 1.2 million. So basically you could say Pool company declared 60% dividends. The dividend payout percentage was 60. Therefore, 40% of the earnings has been retained by Pool company. Now for tax purposes, only the dividend received would be taxable. 60% of this would be taxable right now. 40% would be taxable in the future when the dividend comes in. So guys, on the GAAP books, we have that as income right now. On this tax returns, we're going to have it as income only when those dividends are distributed. So that's more book income today. More book income means deferred tax liability. Deferred tax liability is less in step number 1. So in step number 1, what we would do is we would have the temporary difference relating to deferred tax liability as a less here, and that number would be 40% of $160,000, because 60% has been received as dividends. It would be taxed right now. 40% not received would be taxable in the future. So 40% into $160,000 calculates to $64,000. So the current taxable income, that's $96,000. And now that you've done this, it's simple math now. For the current income tax portion, we're going to multiply this $96,000 taxable income into current tax rate. So $96,000 into current tax rate of 30% calculates to $28,800. Deferred tax liability, which was less, the difference that created the deferred tax liability. Now we're going to multiply this number by the future enacted tax rate. Now in this problem we'll use 30% as the future enacted tax rate. So $64,000 into 30%, look at this, into future enacted tax rate would give us the deferred tax liability, which is an add here. So this number $64,000 would now be multiplied by the same 30% to give us the DTL number. So the DTL would be $19,200, $64,000 into 30%. The total income tax expense for the year would be $28,800 plus the $19,200. So you would say the income tax expense current, that is $28,800. The income tax expense deferred, that's $19,200. And if you sum them, it comes to $48,000, which is the income tax expense going to the income statement. Now guys, let us reconcile the math here. You had $96,000 of taxable income. You had taxable book income of $160,000. Now the current tax that you're paying is on the taxable income, $28,800. But the total tax that you would have to pay now and in the future would be on $160,000. So if you multiply this total taxable book income, $160,000, into 30%, because in this example we have the same current and future rate. So if you multiply this number by 30%, you would get 48,000. So what we would say is, of all the income that's coming on the income statement, on the GAAP books, there would be a $48,000 tax which would be payable now and in the future. Of this $48,000, $28,800 is payable now. It's a current income tax expense on the tax return. $19,200 is a liability. It's to be paid in the future. Total $48,000. Good to go.
Now let's look at undistributed investee dividends on page 13. Now as we saw, there could be box temporary difference due to cost method for tax purposes and the equity method for GAAP purposes. Now under the cost method, only dividend received is income for the period. Under the equity method, all that the investee has earned is income for the period. So even the undistributed dividends are recognized as income. So in that case, highlight undistributed earnings would result in highlight deferred tax liability, as there is more book income today. Let's assume that the undistributed earnings will ultimately be distributed to the investor or parent in the future. Hence this temporary deferred tax liability. Now there could also be, put a box around, permanent difference due to the IRS rules for highlight dividend received deduction. Highlight 0 to 19% stake, that's 70% exclusion. 20% to 80% stake, that's 80% exclusion for DRD. More than 80% stake, 100% DRD. In that case, you can also file a consolidated tax return. Now looking at the example on investee dividends, we have Dive company which owns 40% in Pool company, uses equity method per GAAP. Now we're going to pass journal entries for income tax expense if Pool had net income of $2 million, declared dividends of $1.2 million. And we will go pass journal entries for income tax expense for the year. We are assuming tax rate of 30% and applicable DRD of 80%. 40% ownership means 80% DRD. Now starting from the financial book income of $2 million into 40%, $800,000. Now of this, 80% will never be taxed. So highlight dividend received deduction and write there, will never be taxed. Hence, we're looking at the taxable book income only of $160,000. Now out of this $160,000, we're going to look at how much dividend has been paid out and how much is undistributed. So the dividend payout is 1.2 million out of 2 million, that's 60%. Therefore 40% of the earnings is highlight undistributed dividend, which results in temporary difference, as this right will be taxed in the future. So 40% of $160,000, that's a $64,000 temporary difference. Now to calculate the deferred tax liability, we're going to multiply the $64,000 temporary difference into the future tax rate. 30% in this case gives us 19,200. So highlight deferred tax liability. So in step number 1, our taxable income that calculates to $96,000, $160,000 minus $64,000. In step number 2, the income tax expense for the period, that's income tax expense current plus the deferred tax liability. Income tax expense current, that's $96,000 taxable income into 30%, 28,800. Deferred tax liability, we saw the calculation to be 19,200. So look at the journal entry there. The debit is to income tax expense current 28,800, another debit for income tax expense deferred 19,200, the income tax payable is credit 28,800, and there is a deferred tax liability on the balance sheet for 19,200.
Let's quickly recap on a most important takeaway from deferred taxes. And you know that first you need to ask if you like Miles books. If you do, allocate more time. It's a deferred tax liability if it's more book income today. It's deferred tax asset if it's more tax income. After you've done this, then it's time for you to act. And I've given you a 2-step action plan. Step number 1, you're looking at calculating your taxable income. You're moving from your pre-tax book income to your taxable income. Step number 2, you then calculate your income tax expense for the period, which goes on to your income statement. Now this is the sum of current and deferred income tax. Deferred income tax, that's deferred tax liability for the period minus deferred tax asset for the period. Now for these permanent differences and temporary differences, I've given you a lot of examples. We also have examples on the other side of my board. So these were all temporary differences. Now you'll also be having a lot of more instances of permanent and temporary differences when you're doing your multiple choice questions. But when we finally get to the regulation part of the CPA exams, you'll have a more in-depth understanding of all these differences. So guys, put on your seatbelts. We are set to roll. On page 14, I got a super comprehensive table where we have treatment for a lot of items on the GAAP books versus tax books. Now, for the financial accounting and reporting part of the exams, this is not so important. But after you've studied regulation, you might want to come back to this table and try to understand what's happening for those items on your GAAP books versus what you've done for them on the tax books on your IRS tax returns. So on top of this page, make a note, write review later with Reg 2 and Reg 3. Now once again, this is not a required review, just an optional review to give you more information for you to be able to understand and further appreciate the differences between your GAAP financials and your IRS income tax return.